Intel has been one of my most disappointing stock ratings in 2024. I rated the stock as a buy for the year, and it's down over 60% as of this recording, with 1 day left in trading in 2024. But what about for 2025? Do I still think the stock is a buy for 2025? I'm going to answer that question in this video, looking at various financial metrics for the company, including my discounted cash flow valuation model, which I updated today, and the forward price to earnings multiple to come to the conclusion of whether or not I think the stock is a buy, hold, or a sell going into 2025.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So you probably heard of all of the struggles of Intel leading up to the CEO being forced into retirement and a new CEO coming in. And this revenue chart explains all the troubles very nicely. Revenue down to $54 billion in the trailing 12-month period. That's down from close to $80 billion in 2022. Intel has lost market share in all of the categories it operates in, and it's fell behind competitors in key technologies. The previous CEO tried to catch up by spending tens of billions of dollars on manufacturing expansion and manufacturing quality, capability, skill, technology. Those investments led to huge decreases in cash flow and forced the company into pausing its dividend. Those investments are not going to bear fruit anytime soon, maybe towards the back half of 2025, but really starting 2026 is when Intel will start to reap the benefits of all of those investments they've made. And they've made tens of billions of dollars in investments in the manufacturing side of the business. Intel has long faced criticism from investors for trying to do both semiconductor design and semiconductor manufacturing. Intel and Micron are two of the last remaining US-based companies that still do design and manufacturing. Most of the US-based semiconductor companies have chosen to stick with design, and they've outsourced manufacturing to companies like Taiwan Semiconductor Manufacturing, and that's allowed them to invest more of their capital into research and development and less of their capital into manufacturing. And those that chose that have done better than the companies that have chosen to do both. And Intel, now with the outgoing CEO, there's more discussion that it might actually sell the manufacturing side of the business. That remains to be seen whether or not this would be a good time to sell before the investments are even completed. These buildings are still being completed as we speak. So is it a good time to sell them? I don't know. Probably not. They seem like they're in a position of desperation. And if they were to sell now, they'll probably get a very low price on those assets. So if they can persist a little while longer, maybe in 2026 or 2027, they could do that long awaited and long asked for from investors strategy of splitting manufacturing and design. Although I don't think that's going to be the case because the US government has made it an important priority to have manufacturing inside of the United States, and even more so to have the manufacturing inside the United States controlled by US-based companies and not sold off to companies like Samsung or Taiwan Semiconductor, which are not US-based companies, but they are investing in the United States in manufacturing facilities. I mentioned those investments in manufacturing as being the primary cause of the huge declines in profitability and cash flow. See here, Intel's trailing net income down to $16 billion negative, and its cash flow from operations down to $9.7 billion, down from closer to $40 billion in 2020. So a fraction, just 1/4 of its previous peak in cash flow from operations. And then the company's investing more in capital expenditures than it's bringing in cash flow from operations. And so that's leading to negative cash, negative free cash flow. And that's what caused the company to pause the dividend, which was a big uh, sign of its troubles and what really led investors to sell Intel stock even more than they were already doing. That last straw on the camel's back was the pause of the dividend. They had been struggling for years, but this year they paused the dividend, and that was the straw that seemingly broke the camel's back, and the price really declined following those announcements. Those investments have also put strain on the company's balance sheet. It now has over $50 billion in debt and less than $9 billion in cash. And given its position of negative free cash flow and the forecasts for continued negative free cash flow, the cost for Intel to borrow has increased as they've become a greater risk to investors. So this company had really put itself in a tough position here for this incoming CEO to try and correct. Now, to the previous CEO's credit, Pat Gelsinger told the board of directors, like, this is the strategy I'm going to do when I come in. I'm going to invest in trying to get the company back up to the top in terms of technology. I'm going to invest in that. I'm going to spend that money on that. And before those investments were allowed to ripen and bear fruit, the CEO was ousted. The board of directors, maybe the shareholders, notable shareholders, were not happy with the direction it was heading, and they pulled the plug on the strategy before it was allowed to fully be completed. It was a very difficult, very high degree of difficulty strategy to implement, and it still remains to be seen whether or not the strategy will be effective because those manufacturing investments haven't been completed. They haven't started production. And so I would argue that if they were not going to be happy with this strategy, the board of directors should have decided that and thought about that before they onboarded Pat Gelsinger, who said that this was the strategy he was going to implement. Now changing that strategy midstream, I was not too thrilled about. Someone that's been following and recommending Intel stock in 2024, I was not thrilled about that decision from the board of directors. Looking ahead, the company's free cash flow is expected to be negative for at least 3 more years. The analysts on Wall Street that are following Intel stock, they're forecasting the company to complete the year with negative $18 billion in free cash flow, negative $7 billion in 2025, negative $3.5 billion in 2026, negative $630 million in 2027, and then finally in 2028, they expect the company to start to reap the benefits of these investments with $13 billion in free cash flow expected in 2028. That's a long time to wait. Investors are not very patient, and they've shown that with Intel's stock price. So after these stock price declines, Intel is selling at just about the lowest forward price to earnings ratio it's sold for all year long. It's trading at a forward price to earnings of 20. And if you look at my discounted cash flow valuation model, which I just updated today, December 30th, I have the intrinsic value per share for Intel stock at $36, and the current market price is $19.82. Now, I have forecasted negative free cash flows all the way out to 2027. So negative $18 billion for 2024, negative $7 billion for 2025, negative $3.5 billion for 2026, and negative $630 million for 2027. Even including all that negative over the next few years, I still have the company's intrinsic value per share higher than the current market price, which demonstrates just how much this stock has sold off. It's sold off significantly in recent years. So, all that being said, do I think Intel stock is a buy, hold, or a sell for 2025? Well, I still think the stock is a buy. I think it's very risky. I think this strategy is going to take a long time to bear fruit, and the stock price may not gain the benefit of those investments in 2025. However, if we're thinking long term, which I am, and I'm looking at this business, owning it 5-10 years, I like the price versus the reward potential for Intel at current valuations. Hey everyone, if you like watching my videos, then I've added a great complimentary product just for you. I've written a book that's available for sale now that highlights my 6-step investing framework. Even if you don't follow that investing framework, just reading it and knowing how I evaluate stocks will make it a lot more interesting and informative to watch my videos. I've added the link in the description below.